Just as had been widely anticipated by financial analysts, the MPC has for the 7th time in a row retained the central bank rate at 10%, citing muted inflationary pressures that was expected to further drop. Year-on-year rate of inflation has slowed from a high of 9.2% in June to the current 5.72%, its lowest level in 17 months, helped by lower food prices after good rains boosted harvests. This is despite an increase in fuel prices, which the central bank expects to be muted by lower food prices. CBK says the foreign exchange market has remained stable, supported by strong diaspora remittances, tea and horticultural exports, as well as tourism recovery. Despite the current account deficit widening by 10 basis points to 6.5% of GDP, it is expected to narrow to 6.2% of GDP next month as a result of a slowdown in SGR-related imports. The central bank also notes that credit to the private sector grew 2% in the 12th month to October, compared to 1.7% in the 12th month to September. This means private sector credit growth has maintained the upward trend for the second month in a row. The central bank cited uncertainties over U.S. economic policies and the post-Brexit resolution as among global risks for Kenya. Based on muted inflationary pressures, a stable shilling, private sector credit growth, and a resilient banking sector, policymakers of the central bank have retained the benchmark lending rate at 10%, keeping it at the same level for 16 months. Judith Akolo, The Business Insight.